Good morning, everyone. Thank you for joining us today to discuss the One Big Beautiful Bill Act and its impact on payroll. Our goal is to pass along information we have about this monumental bill and to explain the major payroll provisions so that you'll have a better understanding of what's involved with each provision. We will also let you know what to expect in the coming months to prepare for reporting payroll information for the tax year 2025, as well as for future years. My name is Oscar, and I will be the one to host the discussion today. I am the Learning and Development Department Manager for AHOLA. I've probably been with AHOLA for over 8 years now, and I bring a total of 12 years of payroll experience. If you have any questions regarding today's discussion, please feel free to email me at omahia@ahola.com. So first initial, last name at ahola.com. Please be advised we do have a chat box. I will not be able, due to the amount of information that we're going to share this morning, I will not be able to answer questions live. If you utilize the chat function within the Teams meeting, we will be able to track all the questions. Shortly after the webinar session, the team here at AHOLA will create an FAQ and we will distribute the FAQ to all registrants this morning. So again, please feel free to email myself, omahia@ahola.com. Please utilize the chat box with any questions that you will have. Even though we might not be able to answer those questions live, we will have an FAQ and provide you that information shortly after this webinar. Now, before we begin, I'd like to remind you that we are not attorneys. This session is intended for educational and informational purposes only. We do hope that you find these presentations helpful and informative, but the information presented today should not in any way be construed as legal advice. As always, if you have questions about how this information may affect your business specifically, we recommend that you consult with your business advisor. For those of you who may not know a lot about AHOLA, we are a family-owned payroll and HR service provider headquartered in Brecksville, Ohio, with 55 years of payroll, tax, and HR experience. We've served over 10,000 small businesses nationwide. AHOLA offers a full range of payroll and HR services and software. Today, our staff of payroll, tax, and human resource professionals serve thousands of businesses by helping them with their human capital management needs. Okay, now let's get started with the agenda for today. First, we will give a very brief overview of the One Big Beautiful Act. And if you can't tell already, a lot of participants, a lot of interested eyes, as this is very new information. So we'll give a very brief overview of the Act. Next, we will take an in-depth look at two most impactful payroll provisions, the no tax on overtime and the no tax on tips provision. These two provisions carry the most sweeping changes for employers and payroll companies to implement. We will explain the misconceptions about these provisions and describe the many layers of rules involved with their implementation. Next, we will cover some of the other key payroll provisions that may affect you and your employees. And last, we will discuss some questions that employers should begin thinking about now to prepare for year-end reporting, to comply with the year-end reporting for the no tax on overtime and no tax on tips provisions. Again, if there's any questions, please feel free to utilize the chat function within the Teams meeting, within the lobby, and we'll be able to address those questions at a later time. All right, so the overview of the One Big Beautiful Bill Act. It is very helpful to understand the timeline for federal legislative changes. The One Big Beautiful Bill Act was signed into law by President Trump on July 4th of 2025. As with all federal legislation, the signing of a bill establishes the final result of what is to be accomplished. As of today, we know what is included in the bill. However, after a bill is signed, the appropriate governmental agencies are tasked with interpreting the what and developing how to implement the desired results. There are many unanswered questions at this point about how employers and payroll companies will be required to comply with the provisions of the bill. Now, as we move through the webinar, I will point out what information is pending guidance from government agencies, specifically the Department of Treasury and the Internal Revenue Service. AHOLA will continue to monitor the developments for future instruction about the One Big Beautiful Bill Act, and we will keep our clients apprised of all important information as it is released. The One Big Beautiful Bill Act was introduced to the House of Representatives on May 20th, 2025. It was quickly passed by the House and the Senate, and it was finally signed into law by President Trump on July 4th. The bill forms the core policies for President Trump's second term agenda. Now, the bill is massive, contains hundreds of provisions. Some of the provisions are permanent and some are temporary. For example, the bill permanently extends the reduced federal individual tax rates that President Trump enacted in 2017 under the Tax Cuts and Jobs Act. These tax rates were previously set to expire on December 31st, 2025. The bill permanently eliminates federal personal exemptions as shown on the pre-2020 W-4 forms, which many employees are probably still using. If you remember that when the Form W-4 was redesigned in 2020, employees with existing forms were not required to submit a new document. The IRS has not yet announced if it will require every employee to use the new Form W-4, but it is possible that employees with pre-2020 W-4 forms will need to submit a new W-4. This is something we will absolutely keep an eye on. The bill also includes a permanent $200 increase in the child tax credit up to $2,200 per child. This amount will be indexed to inflation. Some of the temporary provisions include the tax deductions for working Americans, also known as the no tax on overtime and the no tax on tips provisions, which are both effective for tax years 2025 through 2028. Another temporary provision is a tax deduction for senior citizens age 65 and older of up to $6,000, which is set to expire in 2028. This provision has phase-out rules, which are based on income, and it is estimated that 88% of seniors will be able to claim enough deductions to cover their Social Security tax burden. Another temporary provision is a tax deduction for car buyers to deduct up to $10,000 per year in auto loan interest for cars that were assembled in the United States and were purchased between 2025 and 2028. As you are all aware, the One Big Beautiful Bill Act contains several items that will have considerable impact on employers and employees. Let's start by reviewing the no tax on overtime and the no tax on tips provisions. The term no tax on overtime and no tax on tips have resulted in much misconception among employees and have generated many questions from employers. Some of the comments our clients at AHOLA have reported hearing from their employees are, for example, my net pay should be higher than it was in June due to the no tax on tips and no tax on overtime laws. Or, I shouldn't have any taxes withheld on my overtime pay or tips. All of my overtime pay is exempt from taxes, or we've heard all my tips are exempt from taxes. Well, guess what? All of these statements are wrong. We will now learn what no tax really means within these provisions. The first thing to know about no tax on overtime is that no tax doesn't actually mean no tax. The provision simply created a new federal tax deduction of up to $12,500 per year or $25,000 per year for joint filers for qualified overtime pay. Taxpayers will claim this deduction when filing their personal federal tax returns, the Form 1040, at the end of each year. The deduction phases out for taxpayers with modified gross income over $150,000 or $300,000 for joint filers. This provision is retroactive to January 1st, 2025 and will expire December 31st, 2028. Now, here's what you need to know. All payroll taxes still apply to overtime pay. Employees will not see any difference in their paychecks in 2025. There possibly could be differences in paychecks for federal income tax withholding for tax years 2026 through 2028, depending on upcoming changes to the W-4. The deduction for overtime pay will be claimed on the taxpayer's personal federal tax return and will apply to their federal income tax liability. Even if a taxpayer doesn't itemize the deductions, they will still be able to claim the overtime credit. It is an above-the-line deduction. Now, Social Security, Medicare, state in some cases, and local payroll taxes are not affected. It should be noted that for states that use federal adjusted gross income for their tax calculations, the federal overtime deduction may trickle down to state income tax liability as well. This just depends on the individual state laws. There are several requirements that must be met for overtime pay to be qualified for the overtime deduction. These requirements are complex and may require employers and payroll providers to modify the way overtime hours are reported in order to comply with these requirements. For example, it's possible that employers may need to have separate earning codes in their payroll system for qualified overtime pay versus non-qualified overtime pay. Now let's discuss the requirements for qualified overtime pay. The first requirement is that the overtime pay must be required by the Fair Labor Standards Act, or FLSA. The standard rule for FLSA overtime is as follows. For covered, non-exempt employees, the FLSA requires overtime pay at a rate of not less than 1.5 times an employee's regular rate of pay for all hours worked over 40 hours in a work week. There are some exceptions to the 40 hours per week standard that apply to police officers and firefighters employed by public agencies and to employees of hospitals and nursing homes. But for most employers, this is the standard rule that applies. What this means for the One Big Beautiful Bill Act is that only FLSA required overtime pay is qualified for the overtime deduction calculation. Any other overtime pay outside or above the FLSA requirement is not allowed to be used for the overtime deduction. Just a reminder at this point to make sure you're submitting your employees' overtime hours for each week. Per the FLSA, overtime must be paid for over 40 hours worked within the work week. This is important to verify, especially if you're not using an automated time clock system or if your payroll cycle is not weekly. You will want to make sure that you are tracking and reporting overtime hours by work week. Keep in mind that the work week is determined by your specific payroll schedule. For example, a work week can begin with any day, such as a Monday through Sunday or Wednesday through Tuesday, situations like that. Now, here are some types of overtime pay that may be outside or above FLSA required overtime. Overtime pay under a collective bargaining agreement, state law, or company policy that is not required by the FLSA. Those are some examples. These type of overtime pay are not eligible for the overtime. Here's example 1. Suppose the company's policy is to pay overtime for all hours worked over 8 hours in a day. If an employee works 40 or less hours in the work week, then none of the overtime pay is eligible for the overtime deduction. The example on this slide shows an employee who worked 10 hours each day on Monday through Thursday and then called in sick on Friday. Per company policy, the employee is paid 8 hours regular and 2 hours overtime on Monday through Thursday, and then 8 hours of sick time on Friday. For the week, the employee worked 40 hours. So under the FLSA, the employee is not required to be paid any overtime. Therefore, none of this employee's overtime pay is eligible for the overtime deduction. Here's example 2. Suppose that under a union agreement, an employer pays overtime for all hours worked on Saturday, Sunday, and federal holidays. If an employee works 40 or less hours in the work week, then none of the overtime pay is eligible for the overtime deduction. The example on the slide shows an employee who worked 8 hours each day, Wednesday through Sunday. Per the union agreement, the employer paid overtime for 16 hours worked on Saturday and Sunday. For the week, the employee worked 40 hours. So under the FLSA, the employee is not required to be paid any overtime. Therefore, none of the employee's overtime pay is eligible for that overtime deduction. The next requirement is that the qualified overtime pay is only the FLSA premium pay. In other words, the qualified overtime pay is the amount that exceeds the regular rate of pay, or the half portion of the time and a half compensation. Also, keep in mind that only FLSA required premium pay is considered qualified for the overtime deduction. For example, if an employer pays double time for hours worked over 40 in the work week, only the FLSA 0.5 portion of that premium pay is eligible for the deduction. Now let's look at 2 more examples of how the qualified overtime pay is determined. All right, so for the first example, suppose an employee who earns $22 an hour worked 42 hours in a work week. Many employers and employees think the overtime pay is calculated by multiplying the base rate of pay by 1.5, then multiplying that rate by the overtime hours as shown on the slide in that first calculation. Many employees would think that their eligible overtime is $66. However, the no tax on overtime provision applies only to the FLSA overtime premium pay. Now look at the second calculation on the slide. Per FLSA rules, the employee's straight time pay is calculated by multiplying their total hours by their base pay rate. Then the overtime premium pay is calculated by multiplying the regular rate of pay by 0.5, then multiplying that rate by the overtime hours. The qualified overtime pay under this bill is equal to the FLSA premium pay. So in this example, the employee can claim $22 for the overtime deduction, not $66. The second example here shows the calculation of an eligible overtime deduction for an employee that is paid $20 per hour for working the day shift and $25 per hour for working the night shift. The employee worked a total of 45 hours in the week, so he is due 5 hours of overtime. In this case, the FLSA overtime premium pay is $56.95, and therefore the $56.95 is the amount that is eligible for the overtime deduction. And that's highlighted on the slide. The next requirement for the overtime deduction is that the qualified overtime pay must be reported on the W-2 form or other specified statements and furnished to the individual. The IRS will be updating the Form W-2 for tax year 2026 to accommodate this requirement. For tax year 2025, the IRS has announced that there will be no changes to the 2025 W-2 form. We are waiting for guidance from the Department of Treasury or the IRS about whether employers will be required to furnish employees with their qualified overtime pay amounts for 2025. And if so, what the requirements are doing. It is possible that the qualified overtime will be reported in informational box 14 of the Form W-2 for 2025 or on a supplemental form. It's even possible that reporting for 2025 may not even be required from employers. We will have to wait for the official guidance. The final requirement for the no tax on overtime provision falls on the taxpayers. In order to claim the overtime deduction, taxpayers must include their Social Security number on their tax return, and if married, the taxpayer must file jointly. Now that you have a better understanding of what is involved with the no tax on overtime provision, let's look at how employers must comply with this provision. So here's what we know for 2025. Early in August, the IRS announced that there would be no changes in the W-2 form, the Form 941, or the federal withholding tables for 2025. It has been communicated that there is transitional relief for 2025 and that employers are permitted to approximate qualifying overtime by any reasonable method specified by the Secretary of the Treasury. Exactly what this means is not known until further guidance from the Department of Treasury or the IRS is released. At this time, it's also unclear if providing a statement of qualified overtime to employers for 2025 will be required from employers or not. It's also not clear that in the event the reporting is required, where this reporting is going to occur. For example, if qualified overtime will be reported in the informational box 14 of the W-2, or will it be provided on that supplemental statement to employees? Now here's what we know for 2026 through 2028. Qualified overtime will be required to be reported on any updated Form W-2. We don't have any information yet about what box or coding will be used. It's possible that there will be changes to the W-4, the 941, as well as changes to the federal withholding tables. Again, we have to wait for guidance from the Department of Treasury or the IRS for those details. We at AHOLA are closely monitoring developments and will keep our clients and partners informed as these details are released. So that's enough about the no tax on overtime. Let's now discuss the no tax on tips provision. Like the no tax on overtime, the term no tax on tips doesn't actually mean no tax. The provision simply created a new federal tax deduction of up to $25,000 per year for qualified tip income for those employees and self-employed individuals. For self-employed individuals, the deduction may not exceed the individual's net income without regard to this deduction from the trade or business in which the tips were earned. Taxpayers will claim this deduction when filing their personal federal tax returns, the Form 1040, at the end of each year. The deduction phases out for taxpayers with modified adjusted gross income of over $150,000 or $300,000 for joint filers. This provision is effective for the tax years 2025 through 2028. Here's what you need to know. All payroll taxes still apply to tips. Employees and independent contractors will not see any difference in their paychecks in 2025. There possibly could be a difference in paychecks for federal income tax withholding for tax years 2026 through 2028, depending on the upcoming changes to the W-4. The deduction for tip income will be claimed on the taxpayer's personal federal tax return and will apply to their federal income tax liability. Even if a taxpayer doesn't itemize deductions, they will still be able to claim the tips credit. It's an above the line deduction. Social Security, Medicare, state in some cases, and local payroll taxes are not affected. It should be noted that for states that use federal adjusted gross income for their tax calculations, the federal tip deduction may trickle down to state income tax liability as well. This just depends on the individual state laws. There are several requirements that must be met for the tip income to be qualified for the tip deduction. These requirements may require employers and payroll providers to modify the way tips are reported in order to comply with these requirements. For example, it's possible that employers may need to have separate earning codes in their payroll system for qualified tips versus non-qualified tips. So let's discuss the requirements for qualified tips. The first requirement is that to qualify for the tips deduction, tips must be cash tips received by an individual in an occupation that customarily and regularly receives tips on or before December 31st, 2024. Now, the term cash tips means both cash and charge tips. Customary occupations include servers, bartenders, hotel staff, hairstylists, and other occupations similar to that. The IRS will publish a comprehensive list of eligible tipped occupations by October 2nd, 2025. This is something that employers need to prepare for. Employers that do not currently store tipped workers' occupations in their payroll systems will most likely need to add that information to correspond to the occupation names on the list published by the IRS. So keep an eye out for more information about that to be coming soon. The next requirement for no tax on tips is that to be qualified for the deduction, the tips must be voluntary cash or charge tips received from customers or through tip sharing. The emphasis here is on voluntary. Tip income that is not voluntary is not qualified for the tips deduction. Examples of involuntary tips include required gratuities added to the bill for large parties and mandatory service fees and charges. Also remember that only tips received for the IRS's list of qualified occupations are eligible for the tips deduction. As I mentioned earlier, the tips deduction applies to both employees and self-employed individuals. For example, workers that employers are paying as 1099 contractors. This is another important thing that employers need to prepare for. If you have any 1099 contractors that customarily receive tips in their occupation, then you'll possibly need to have separate earning codes in your payroll system for now qualified 1099 tips and non-qualified 1099 tips. Many of our current clients at Ahola with 1099 workers don't currently designate 1099 tips separate from other 1099 earnings. So I know this is something that will need to be addressed. The next requirement for the tips deduction is that the qualified tips and the occupation of the tip recipient must be reported on the W-2 form, the Form 1099, or other specified statements and furnished to the individual. The IRS also allows taxpayers to report unreported tips directly on the Form 4137. The IRS will be updating the Form W-2 and Forms 1099 for the tax year 2026 to accommodate this requirement. For the tax year 2025, the IRS has announced that there will be no changes to the 2025 W-2 or 1099 forms. We are waiting for guidance from the Department of Treasury or the IRS about whether employers will be required to furnish the employees with their qualified tips and occupations for 2025. And if so, what the requirements are for doing that. It is possible that this information may be reported on the informational box 14 on the W-2 for 2025 or on a separate supplemental form. It's even possible that reporting for 2025 may not be required from employers. We will also have to wait for further guidance. The final requirements for the no tax on tips fall on the taxpayers. To claim the tips deduction, taxpayers must include their Social Security number on their tax return, and if married, the taxpayer must file jointly. Also, please note that self-employed individuals in a specified service trade or business, or employees whose employer is in a specified service trade or business, are not eligible for the tips deduction. Now that we have a better understanding of what is involved in the no tax on tips provision, let's look at how employers must comply with the provision. So here's what we know for 2025. As stated earlier, the IRS announced earlier this month that there would be no changes to the W-2, the 1099 forms, or the 941, or the federal tax withholding tables for 2025. It has been communicated that there is transitional relief for 2025 and that employers are permitted to approximate qualifying tips by any reasonable method specified by the Secretary of the Treasury. At this point, we don't know exactly what or how employers will be required to report qualified tips for 2025. Further instructions are expected to be released from the Department of Treasury and the IRS in the coming weeks. And here's what we know for 2026 through 2028. Qualified tips and the occupation of the tip recipient will be required to be reported on an updated W-2 or the 1099. We don't have any information yet about what boxes or coding will be used. It's possible that there will be changes to the W-4, the 941, as well as changes to the federal withholding tables. Again, we must wait for guidance from the Department of Treasury or the IRS for those details. And of course, at AHOLA, we're closely monitoring these developments and will keep you informed as these details are released. So that covers the main points regarding the no tax on overtime and the no tax on tips provisions. Now I want to point out a few of the other payroll-related provisions on this bill. The One Big Beautiful Bill established a new tax advantage savings vehicle for children called Trump accounts. These are custodial savings accounts for qualifying children under the age 18, and the accounts are similar to IRA accounts. Children must have a Social Security number to be eligible for an account. It's expected that Trump accounts will be available starting in July of 2026. Employers may elect to offer a new benefit to employees for these Trump accounts. Employers may contribute up to $2,500 per year to Trump accounts for their employees or employees' children. The employer contributions will be tax-free for employees. They will not be included in the employee's taxable income. Please note that if employers wish to make contributions to Trump accounts, they'll need to have a written plan document that follows certain rules, such as the prohibition of discrimination against certain income groups and notice to eligible employees. Contributions may be made to Trump accounts up to $5,000 per year, which includes employer contributions up to the $2,500. These limits will be adjusted for inflation over the years. A big incentive for opening a Trump account is that the United States government will make a one-time deposit of $1,000 to the Trump accounts of children born in the United States between January 1st, 2025 and December 31st, 2028. This $1,000 contribution does not count against that annual limit. Another provision in the One Big Beautiful Bill Act is a change to the reporting threshold for Forms 1099 NEC and the 1099 MISC. Previously, employers were required to file these forms if payments of $600 or more were paid to an individual. The threshold has been increased to $2,000 starting with the tax year 2026, and that'll increase for inflation each year. This means that employers paying less than $2,000 in 1099 pay to a contractor will not need to issue a Form 1099 in 2026. There are just a few more provisions that I would like to point out to you. The One Big Beautiful Bill Act enhances and makes permanent the paid family and medical tax credit, which was previously set to expire in 2025. This is effective in 2026 and includes allowing employers in states with mandated paid family and medical leave to claim the credit not only on wages paid during leave, but also on premiums paid for insurance policies providing paid family medical leave. Making this credit permanent is expected to encourage employers to invest in paid leave programs, which will help attract and retain employees. This bill increases the maximum annual income exclusion for Section 125 dependent care flexible spending accounts to $7,500 or $3,750 for married individuals filing separately, and that starts in 2026. To be eligible for this, employers must amend their Section 125 cafeteria plan documents. The bill includes expansions for health saving accounts, including coverage for telehealth and remote care services retroactive to plan years beginning in 2025. It also allows employees to use pre-tax health dollars to pay for direct primary care service arrangements, of course, with limitations, and that's effective in 2026. Finally, the bill includes increased funding for immigration and customs enforcement. This could impact employers as a result of increased ICE workplace activities, such as I-9 audits and worksite inspections, especially in industries such as agriculture, construction, hospitality, retail, and manufacturing. So we're coming to the end of today's webinar. As I stated in the beginning of today's session, there are many unanswered questions about how the One Big Beautiful Bill Act will be implemented by employers and payroll providers. We are waiting for upcoming instructions and guidance from the Department of Treasury and the IRS to address these questions. In the meantime, employers should review their payroll data and start thinking about what they may need to do to comply with the bill's requirements. On this slide are some questions that you can think about to prepare for the no tax on overtime and the no tax on tips provisions. Please take a minute to read through these questions. Knowing the answers to these questions will prepare you for the needed changes that may be requested by your payroll provider after the official guidance is released. As stated earlier, the slide deck and questions and answers from the chat box will be sent to everyone who registered for this webinar. A lot of information was shared this morning, but I do appreciate the participation, the registration. Thank you so much for attending the webinar about the One Big Beautiful Bill Act. We hope that you have a better understanding of what to expect as these provisions are implemented. Again, if you have any questions, please feel free to enter your questions in the chat box. As I won't be able to answer the questions live, we will create an FAQ and distribute that document to anyone who is registered for this session. Thanks again, everyone. Please enjoy the rest of your day.